Bacha, can you hear me?
Hello, yes, I can.
Right, okay, very good. Can we start now?
Yes, we can.
Yeah, any questions you have before I start?
Sorry?
Any questions you have?
Yes, I have two questions.
Yeah,
The first one, do you know if INSAF has received my payment?
they have received, yes. They confirmed to me yesterday they have received the payment or today this morning.
Okay, perfect.
Yes.
And the other one is just related to my studies. The question that I asked you 2 days ago
Yeah,
is related because I'm very concerned
yeah,
about what I have to do apart of the classes.
yeah.
And I try to explain you if you are gonna guide me through my studies. I mean, not only give me the lessons.
Yeah.
You know what I mean?
Yeah, what we can do is, what I can support you is, I can do the lesson. I can give you certain questions for you to do. That should be the kind of way for you to do it. And what I always advise is, now I will send you the BPP textbook for you. What I say is always, after the session, read that part of the lesson.
Okay, okay.
Yeah, read that part of the lesson after my lesson, because sometimes when you read before the lesson, you might get confused. So once I finished up, say for example, the long-term finance, read in the BPP textbook that part of it, see whether you understand everything. If you have any difficulties in whatever the area, just send me a mail saying the book says something, what is it, then I will explain it to you more further.
Okay, okay, perfect,
Yeah.
perfect. What about the case study? Are you going to teach me the ways to answer the questions and everything or not?
Yeah, case study will be a separate one. Once you complete all three areas, we will go into the case study. And case study, what we do is we look at the particular case study. Now, for example, this time in November exam, it's all about a telephone company, a mobile phone company. So what we will look at is, we will look at the pre-scene that is given. We will work out some mocks for you, the possible questions that they can put up based on the pre-scene, and we will do the questions, we will do the answers, we will correct it for you and guide you completely for the case study.
Okay, perfect. This is my concern.
Yeah.
Okay,
Yeah.
perfect.
Now I'll just for your explanation, I mean, just for your information, I'll show you about the case study, because this time the case study is all about phone company.
Uh-huh.
What we are doing is, we are doing, we take different subjects and we take a particular mark, maybe on the ratios. We think that this kind of a question can come, and we will discuss with you these kind of questions.
Okay.
So each area we will take it up. So I think I have already the November case study. I have done about 12 or 13 45 minutes section questions. I have done it with my students, and we have given the answers, and they themselves send their answers. We correct it for them and we tell them where they go wrong, all that. So we do that one.
Okay, perfect.
Yeah. As far as the objective test paper is concerned, what I always recommend is, now once I finish up the long-term finance, I will send you the BPP textbook today. Read that part of the textbook. See whether you understand anything. If you don't understand, just let me know. And then I will let you know, either to the mail or to in one of our classes. We can discuss. And also, I will send you some questions once I finish up this chapter. You will answer and send it to me. Then I will let you know, where you are making mistakes or where it can be improved, all that kind of a thing.
Okay, perfect.
Right. Okay. So we will start off from where we stopped last time. We said there are two the companies, particularly the businesses, the companies, they are limited by shares. That means the shareholder liability is limited to the extent of the money he has invested in shares or what he has promised to invest in shares. Beyond that, if the company makes a loss, if the company goes bankrupt, you don't need to bring your private properties. That's what we call limited liability. But the moment it's unlimited liability, even your private properties need to be brought in to settle the business losses, business liabilities, business obligations. The companies can be listed in a stock exchange or can be unlisted companies. When it is listed, the advantage for the shareholders, there is a ready market at all the time. So remember we discussed two functions, the primary function, secondary function of the stock exchange. Primary function is basically to get money to the company. Secondary function is to do the transactions between the shareholders. When one shareholder wants to sell the shares, he can sell it to another shareholder and the company won't get affected. Company's monies are not affected, but the two people will do the transaction. Of course, the company will be informed by the stock exchange. It's no longer Kumar who is the shareholder, but Boju is the shareholder. So because of that, the next dividend declaration, it will come to you and not to me because I'm no longer a shareholder. So generally, big companies you see in UK, in Spain, in Sri Lanka, all over, generally they are listed companies. But when you list, there are a lot of advantages, lot of disadvantages. The first thing what you do when you list a company means you are subject to lot of regulation by the stock exchange. In a way you lose your freedom. You can't do the things that you want to do it. They will specify you must comply with the international accounting standards, international financial reporting standards. They will say you have to comply with corporate governance. All sorts of regulations are put when the company becomes listed. Why? Because when the company is listed, you can invite any public to invest money. So as a government, as a regulator, there has to be some kind of regulation to protect the public money. If it's a family concern, it's all right. You manage it. If you don't manage it, you will lose your money. But no public is involved. To that extent, the the freedom for you to manage the way you want is there. But the moment you say listed, your freedom is restricted. However, by the same token, because the freedom is restricted in a way, you manage the company very well. You have this so-called corporate governance, risk management, because you have to manage the company whether we like it or not to the satisfaction of the stock exchange and other local legislation. And therefore, invariably, the company is properly guided, properly managed, properly controlled. And therefore, that kind of a company is considered to be a better company than a unlisted company. And thereby, you can attract good employees because listed companies can get the best employees because the people would prefer to work for a listed company because their image, their profile is very high compared to an unlisted company. You can get loans from the banks at different rate, at a better rate of interest than an unlisted company. You can get good credit terms from your suppliers when you are listed than when it is unlisted. However, there are a lot of big advantages, but there are some disadvantages also. One of the biggest disadvantages is you are being restricted. You are being regulated. You don't have the freedom to do everything. You have to take stock exchange permission to do many things. Also, listing itself is very costly. Not that everyone can go and apply for the stock exchange. You have to go to a process, you have to go to a procedure, you have to spend a lot of money, and that can be very expensive. So I have listed few advantages, few disadvantages. Advantages: once listed, market will provide a more accurate valuation of the entity, because the moment it is listed, you have a market price. When it is unlisted, you don't have a price. So if you want to sell your shares, you have to negotiate a price. But once it is listed, every day the stock exchange will say, this is the price of your share. You can look at the newspapers, you can look at online, you know the price of the share all the time. Realization of paper profits. What do you mean by paper profits? Imagine you have a company that is your father's company, family company. You are holding 10 million shares in that company. But it's only a piece of paper. You have a share certificate, but you can't sell it because you don't have a market. But the moment the company goes listed, you can sell your shares. So what was in the paper gets converted into money, into profit once the company is listed. Otherwise, you have to find a person to whom you can sell, and when it's a private company, you have to get the permission of the directors to transfer those shares. So it's not easy. You may feel that you have $50 million, but you can't realize it. It's limited to the paper. But the moment it is listed, there's a market, you can sell, you can do whatever. So you can buy shares, you can sell shares in the future. You don't need to hold on to the shares. If the price is going up, you can sell it. When the price is coming down, you can buy. All those things are happening. Surely the company image, the company profile goes up when it's a listed company. And also, it facilitates to raise capital from the bank, etc. Because the banks recognizes when you are a listed company, that company to be properly governed, better managed, better controlled, better risk management, all that, because it's a public company, because you are regulated. Any idea you have about what we call executive share option schemes or employee share option schemes? Any idea that you have? ESOP.
Yes, I think that it is when sometimes the company or you have a bonus to work in some company, and sometimes the company gives you the option to exchange the bonus with shares.
Very good.
Is that right?
Yeah, in a way it's that, because actually the origin of this happened somewhere in 1970s or 80s in America. The directors, they draw big salaries. Now directors are the people who are managing the company. The shareholders are the owners of the company. But what happened in 1970s, 1980s, the directors were taking big salaries, big bonuses, and there was nothing left for the owners, the shareholders, because the directors are taking everything in form of remuneration, bonus, pensions, this, that, and the other. Nothing was left as a profit to the shareholder. So there was a big cry saying that the directors are unfair, and there was no way to regulate. So I think in America, what they did was they said the maximum the directors can draw as a salary is $1 million. They bought a restriction. And guess what happened? The directors thought whether they work till 2 o'clock in the afternoon, or whether they work till 4 o'clock in the evening, or whether they work till 6 o'clock in the evening, they get maximum only 1 million paid. So at 2 o'clock, they started packing their bags and were going home. what do you think happened to the companies? Because the directors are the live wire of the company. They were not working because they thought whether we work or not, we get only 1 million. So they decided, the company started collapsing because the directors are not interested in doing the work. So the Americans had to find some way to keep these directors also happy without giving them a big salary. So what they said was, okay, today, 20th of October, you join the company. You can be a director. You can be a senior executive. So when you join the company, the share price of the company today may be 20th of October. The share price of the company may be $7. $7 in the market. So they say, okay, Bojo, you start working in our company. You work till 2021, 5 years, and they will give you an option to buy, shall we say, 500,000 shares in 2021, not today. You have to complete 5 years of service or 3 years of service or whatever. If you do that one, if you perform well, you are entitled to buy 500,000 shares of this company, maybe at 7 or maybe at 750 or something like that. Predetermined price. So today they fix it saying, okay, in 2021 you are entitled to buy 500,000 shares at 750. Today the share is 7. And you work hard, very hard. And because you have worked very hard, the directors have worked very hard, the share price on 2021 October is in dollars. Now, even though the share is $10, you can buy it at 750. So immediately you will get a bonus in form of a bonus 250. 500,000 into 250, you will get a bonus of 1,250,000, or your wealth will go up by 1,250,000. You can buy it at 750. You can buy it at 750 and sell it at 10. 10 is the market price. So this is what we call the exercise price.
How would you call it?
Exercise price. EXERCISC. You have the option to exercise that option and buy the shares at 750 in 2021. Not today, but in 2021. And the market price is 10. So you can buy it at 750. If you want, you can keep it. If you want, you can sell it at 10 and you make a big money. What happens if the share price on this day has come down to 7? 7.
You lose money.
You don't buy it. You don't lose. You don't buy. The
Well,
option is,
you don't earn money.
yeah,
You
you
don't
don't
lose
earn.
anything.
You don't earn, you don't lose, but you don't earn anything. Isn't it?
Yeah.
That because the option
Yes.
is yours. You are not compelled to buy it. If you want, you can buy it. If you want, you don't buy it. So at 10 o'clock, you are not going to refuse it. At $10, you are not going to refuse it. You will buy it. But if it is $7, you will just forget about it. You are not going to lose it, but you are not going to earn that bonus. So you will work very hard to make, because there was a problem, because in America there was a big problem. The directors are willing to work hard. And also there is another problem. In a company, the people who have put their money are called shareholders. The people who are managing the company are called directors. Now, in your mind, who will take the bigger risk, the directors or the shareholders?
The shareholders.
Pardon?
The shareholders.
Very good. Shareholders, because they put their money, they want the risk. They want to take risk. When you take a risk, what happens? When you take a risk, you try to do something different. Shareholders want the directors to do something different. But the directors sometimes, when they are paid a fixed salary, they are not prepared to do something different. They just want to continue doing the same old thing. They are not taking any risk. Why? Risk means when you take something, it can fail, it can succeed. If you look at a man like Bill Gates, he took a risk and started developing something called Windows, which he succeeded. There are many others who have started something which did not succeed and it went off. The Google started something called Google Lens or something. It did not work. It collapsed. So, but people will have to do something new. That's what we call taking risk. And business must take risk. If when the business don't take risk, they don't grow. They don't have that competitive advantage. They will be doing the same old way all the time. Look at the mobile telephone industry, right? Lot of new technology, lot of new developments have taken place. Now they are thinking of introducing the 5G phones. So some people are taking risk and developing something new. It may work out, it may not work out, but people will take a risk. When they take a risk and do, and if it succeeds, shareholders will benefit. So generally the directors don't like to take a risk because they believe they get a salary. Why should I take a risk? If I take a risk and if I fail, I may lose the job here. No one will ever give me another job here because because you are called a failed director. So you don't want to fail. So you play very safe. But because of these share option schemes, what happens is the directors are also now interested in taking risk, doing something different because they know if the share price goes up, they will be well off. So they will take a more interest. They will try to innovate things. They will try to think out of box and do it. And that's what a executive share option scheme. So this will be a topic in one of our next areas in what we call IFRS 2, employee share benefits. We will look at that one, but I want you to understand what it is. And because we give share option schemes, when you employ people in a company, there are three things what we have to consider, or why we pay a remuneration is for mainly for three things. One is to attract good people. If you don't pay a good remuneration, you can't attract good people. Second thing, you pay a good remuneration giving annual increments or whatever to retain people. If you don't increase the salary every year or something like that, people will not stay, people will go to the other company. So you lose the experience of those people. And you pay a good salary, good incentive, all that to motivate people. So basically the purpose of a remuneration is to attract, to retain and to motivate people. So for to do all that kind of a thing, what we need is we need people who will be attracted, retain, motivate, and through the share option scheme, you can attract people. It's not only a salary I'm offering you, I'm offering, Bojo, come and join my company. You are entitled for 500,000 shares at 750. So you are attracted to that. Not only a salary, if you work very well, if the share price goes up to 10, if the share price goes up to 11, you are in for a big bonus. You are attracted. You can retain people. Why? Even if you get a good job in 2020, you will not leave because you have to work till 2021 to get this bonus. So because of that, you are not going to leave. So you can retain people. You can motivate people because there's something for them to look forward. So they are driven by the executive share option schemes, and therefore the people will take more interest in the company than otherwise. So these are the reasons. So in a listed company, the big advantage, you have to remember, even unlisted company can offer executive share option scheme. But a listed company, it becomes very apparent, very immediately you can see the benefit because you see the market price. Today you join $7. Tomorrow it's 7.25. 1 year later it is 8. You can see how it is moving. So it is very obviously seen the benefit of it, and that is what the advantage of a listing company.
Okay.
Yeah. Disadvantages, as I said, all good things have finally some bad things also. It's very costly for a small company. It's very difficult for them to enter into the stock market because it's so costly, the procedures involved, all that, and therefore that's a disadvantage. And also, particularly if it's a existing company. Now let's assume that your company it's a private company.
Kumar,
Yeah,
one question.
yeah.
What is floating cost?
Floating cost is to make the company listed in the stock exchange. You have to pay lot of charges to the stock exchange itself, and also you have to issue something called a prospectus. So there are certain expenses what you have to bear to list the company. Floating is another name for listing. It's another name for listing. So to list a company, stock exchange will say, okay, you want to list it. What is the total share value? 3% of that you have to pay as a floating cost. And also there's something called underwriting. Do you know what is underwriting?
No.
What is underwriting? Now, let's assume you are a company. We can be a private company, but you can be an unlisted company. Today, on the 20th of October, you decide you want to come to the market. You got a listing, you want to come to the market, and you want to issue 1 million shares to the public. Now you have to decide at what price shall we issue. What price shall we come, the issue price. So you will look at the market, you will look at many things, you will look at your company history, you will probably get some advice from the so-called experts. They will say, okay, Bojo, your company, it's good company, and you can come, your nominal value of the share is £1. That's all right. But you can come to the market at £7. So you want to issue 1 million shares. Why? You want to raise 7 million money. You will decide at the rate of 7 per share, you will issue 1 million shares. But that is your guess. As directors, you think 7 is a good price. But when you come to the market, you find, wow, not all the people are willing to buy for 7. Only 800,000 shares are going at 7. So you can raise 5.6 million, but you want 7 million. Now, there are not other 200,000 people who are willing to. So what you do is, before you come with the issue, you go to an underwriter. Underwriter is like an insurance company. You go and tell, hey, I'm coming out with a 1 million share issue. I want to underwrite it. What do you mean by underwriting? If 800,000 shares are bought by the public, the what is not bought by the public, the 200,000 shares, underwriter will buy at the rate of 27.
Okay.
Rate of 7. So you are guaranteed, it's like insurance, you are guaranteed you will get your 7 million. So you can do the project. Otherwise what will happen is you have got 5.6 million, you are short of 1.4 million, so you have to look up and wait. You can't do the project already, but you have got 5.6 million. What are you going to do? But by going to the underwriter and getting that underwriting agreement, so you have to do that before you issue the share, right? So the balance 200,000 shares, they will buy it. They will give you the money, but they won't do it just for free. They will say, okay, Bojo, you're coming out with 1 million shares. Total amount expected is 7 million. 7 million. I want 3% of the 7 million as my underwriting fee. That's like insurance premium. It can be 3%, it can be 4%. You pay 210,000 and enter into an underwriting agreement. And you might find 900,000 people have bought. Then underwriter will buy the 100,000. But you have to pay 210,000. If 600,000 people buy, underwriter will buy the balance 400,000. But you have to pay that 200. It's like insurance. Whether you meet with an accident or not, you have to pay the insurance premium. If you meet with an accident, this is like an accident. You expect the public to apply for 1 million, public apply 800. Okay, the underwriter will come and say, don't worry, Gojo, here money for 200,000. They will buy these shares and they will sell these shares later. If the public buys 600, they will give the balance 400. What happens if the public buys the entire 1 million? Then underwriter need not buy anything because you have got all your money. But still, you have to pay the 210,000 commission. So whether he has to buy or not, underwriting fees need to be paid. So particularly when it's a listed company, you come to the market because you want to raise money, probably to do a particular project. You have to say why you are raising money. You can't just say, I want money. You have to say why you want to say. You will say you want to acquire another company or you want to invest in Vietnam and for whatever, you need $7 million and you are coming out. So when you come out like that, and if you find that, only 5.6 million has come, you are in a fix. So because of that, generally all the listed company, before they come, they will enter into an underwriting. Underwriting is costly because you are not sure whether all the people will buy the shares. If they don't buy, underwriter will buy. But whether he buys or not, he need not buy if all the people have bought the 1 million. If he has to buy or not, he has to still, you have to pay the underwriting commission, which is costly. That is one part, one disadvantage. Other one is imagine your family company, you have 1 million shares between your sisters, father, mother. The family holds the 1 million shares at the moment. But you decide it's time for you to go public. Listing. Public means listing, right? You want to float it. You want to get a quotation. So listing is a name for public. In public. Another name is floating. Another name is quotation.
But sometimes a public company could not be listed.
Public company, correct. Not all the public companies are listed. There are listed public companies, there are unlisted public companies, there are private companies. Three types of companies. Private companies means the shares, if you want to sell your shares, it's like a family concern. If you want to sell your shares, you can't sell it to every Tom, Dick and Harry. You have to ask the family members and with their permission only you can sell your shares. So the transfer of shares are restricted. If it is an unlisted public company, you can sell shares to anybody that you like, but you don't have a market. You have to go and find a buyer and sell your shares. You don't need the permission of the directors to sell your shares. When it's a listed company, you don't need any permission. You can just sell and there's already a market. So what you said was correct. There are public companies unlisted. There are public companies listed. We are talking about listed public company. They are what we call listing, floating, quotation. Right?
Okay.
So what I said was, okay, let's assume that you are a private company at the moment, 1 million you are holding, and the company, your parents, your brother, sister, everyone had decided you want to go public. Why? Because you want to, maybe part of this money you want to realize it. So maybe you will say, out of the 1 million shares that you are holding, the family is holding 400,000 shares will be offered to the public. So then what happens? Now all this time, the entire 1 million is with the family. So you had 100% control. The moment you issue 400,000 to the public, how much is left with you?
600.
600,000. So your control, which was 100%, will now come down to 60%. 40% will be owned by outsiders. So this is some worry. Sometimes family companies, they don't go public because they believe the control what they have will be lost. And the reporting requirements are very onerous. When it's a private company, you don't need to disclose everything. Here, you have to disclose everything and anything. I remember a long time back in somewhere 1990s, I negotiated a very, very super facility with my banker. I was a private company at that time. I made a very super negotiation with the banker at that time, because it was not even heard of that time. But I came to Manchester Business School, did a course. I learned something. I came and told Sri Lanka banker, my main banker, hey, we have 20 odd subsidiaries at that time. Certain bank balances we had favorable balances. Certain bank balances we had unfavorable overdraft. I said, you can charge interest only after netting off all the balances. Only on the net balance I will pay the interest. That was something new at that time in 1980, and they agreed. So I got the facility. I saved lot of money to our company because there were a lot of overdrafts all over. We were paying overdraft interest, but there were some balances in some big bank accounts which we were using, but we were not getting any interest on the credit balances. But on the overdraft we had to pay. By netting off, I paid only on the net balance, net overdraft I had to pay, and I saved lot of money. But unfortunately, that year we decided to go public. And guess what happened? The moment I went public, I had to disclose that my secret negotiation with the banker, I had to disclose saying with the Citibank of Sri Lanka, with Citibank of America, I have entered into an agreement, and because of the agreement, they charge interest only on the net balance. Guess what happened? All my competitors came to know, hey, Citibank is giving this facility to Kumar, why not for us? So what was secretive became public. So that can be a disadvantage because you have to expose everything. The interest rates are known, everything is known in the annual report of a public company. If you see, uh, almost every detail is given. And rules to obtain a quotation, what I said was a floating, quotation, listing. It refers to the same thing. So rules to obtain a listing may be very stringent. They will say you have to show 3 years past profits. You have to show that your board of directors are competent. You have to show that you have a future strategies, all that. So it can be very, very stringent. The rules can be very stringent. So these are some of the disadvantages of listing. So, okay, there are two capital markets, two stock exchange.
One,
Yeah,
1 second,
yes,
Kuma.
yes.
I don't know if it is normal, but when you write on your screen, it's very difficult to hear you for me. I
I
don't know
know,
if it
yeah,
is.
yes, yes. That is why sometimes when you just tell me, sometimes when I'm writing, I don't speak. I know, when I'm speaking and writing, the voice gets broken. Yeah, right.
Okay.
Just let me know. Sometimes I forget and I write it and speak, because normally when I'm speaking, I don't write. Yeah, right.
Okay.
Yeah, just tell me if the moment it gets disturbed, let me know. Let me know. Okay.
Okay.
The UK in you are based in UK at the moment, no?
Yes, I
Yeah.
am.
Right. UK, there are two stock exchange. Yes. One big, the big one, what we call the London Stock Exchange. And also there is another stock exchange, what we call Alternative Investment Market, commonly called A. So because SEMA is UK based exam, we must know about little bit about the two stock exchanges. Most of the countries they have, but UK, surely they have the big one, the London Stock Exchange, and the second one, Alternative Investment Market. So, the London Stock Exchange, all the big companies, the mature companies, the well-established companies are listed in the London Stock Exchange, because these companies are very, very responsible companies. They need to be scrutinized very, very carefully, and therefore these companies are listed in the London Stock Exchange. So they are very high profile companies, and the shares are extremely marketable. I mean, those shares are, it's like gold, you can just sell it at any time because there's a ready market for that one. But there are some young companies, not so mature, the upcoming companies, they want to go for a listing. They can't go to the London Stock Exchange. Reason? Very costly, very restrictive, lot of information need to be given. So to facilitate small companies to get into listing, they have another stock exchange called Alternative Investment Market, the AIM. This is essentially for smaller companies, for young companies, the company that is coming up. It's a stepping stone to go to the full stock exchange. After some time, once the company is doing very well, you can apply to the London Stock Exchange. So you get promoted to the London Stock Exchange. So in any market, whether it's the full stock exchange or the alternative investment market, always the price is decided, you have to remember, not by the directors, it is decided by the market. The market means there has to be a market, means there are sellers and buyers. So depending on the demand and the supply, and the performance, so when a company performs very well, there's a bigger demand for the shares and the price will go up. When the companies are not performing well, the demand will come down and the price will come down. So it works on the demand and supply. So this morning I was trying to buy some shares of a particular company in Sri Lanka. My stockbroker said the demand is very high and the price is going up. So I could not buy. Right? So company that is performing well will have a big demand, and therefore the share prices will go up. So this is how the market is working. It's the same old economic theory, demand and supply. Two stock exchanges, one for the big mature companies, second one for the smaller, younger companies. So we were talking about the various ways to raise money last time. The share capital market, we can go and issue shares, we can issue debentures, we can issue bonds. Yeah, sorry, Bojo, yeah.
One question.
Yeah.
Is there any difference between stock exchange and capital market?
The stock exchange, the capital market is stock exchange.
It's the same.
Same. The name,
Okay,
because in different, when you say capital market, it is the stock exchanges. But different stock exchanges now, for example, in UK, the capital market comprises two stock exchanges, London Stock Exchange and the Alternative Investment Market. Capital market means the stock exchanges.
Okay, all together.
All together.
Okay, now
If you
I
look
got
at,
it.
when you say the capital market of the world, all the stock exchanges are capital markets. So listed
Okay.
companies can go to the that particular capital market and raise money and sell shares. So we discussed that way the companies can raise money if it's listed through the stock exchanges, through the primary function. Also we discussed the companies can raise debts like bonds, debentures, etc. through the capital market. Also we discussed the companies can raise money through banks. Also we discussed the companies can raise money through venture capitalists. Also we discussed the companies can raise money through government grants, etc. Another way is the private equity. There are some companies called private equity firms. It's essentially like venture capitalists. They will come and invest money in unlisted company that is not quoted on the public exchange. That is for unlisted companies, another source of funds available is private equity. So they are the people who have a lot of money, or maybe companies they have a lot of money. They are called private equity participants. They will come and invest in unlisted companies, and that's one way they will put their money. Sometimes they invest in public companies that result in a delisting of public equity. Sometimes the company is already a public company, but they find listing is a very, very tough one. They have to disclose lot of things, all that. They might decide to delist it. Delist means you want to get away from the public listing. So for that purpose, what you do is you invite a private equity partner, come and invest, and with that money, you will buy those shares from the public, so you become an unlisted company. So in the recent past, we have seen some big listed companies becoming unlisted, because I was doing some research on Sri Lankan companies. We found some of the big companies going unlisted or delisted. Reason what they said was too much of information to be given. You don't have that competitive advantage, so better for us to delist our companies. So capital for private equity raised from retail and institutional investors. There are two types of investors in a company. One is you and me, who are called individual investors. So we bring our money. Individual, we bring our money, we put it inside the company. If the company does well, we will do very well. If the company fails, our money we will lose. That's the end of it. But there's another kind of people who are called institutional investors. Institutional investors. Who are these people? You know, you join a company and they promise you a pension. So they will set aside certain amount for you to pay a pension, and those monies are collected by people called pension funds. So they take that money, your pension money contribution, my pension contribution, and they go and invest in various companies. Pension funds, the institutional investor. So if the company fails, who will fail? Who will be the loser? Is the direct investor or the pensioner? Who will be the loser?
The pensioner.
Pension, isn't it? A third party will be the loser. Individual, you have taken a decision and you have lost your money. Your wife will scold you. Your parents will scold you. That's okay. End of the story. But institutional investors, they take a decision because of their good or bad decision. The people who can get affected is a third party, which is the pension fund. The banks. Banks take your money. Banks take my money, and they go and invest in company shares. And if the company collapses, whose money they have invested? Your money, my money. We will lose our money. So because of that, in fact, there is better coordination or more stricter regulations when there are institutional investors. So these people can become these private equity partners. They have a lot of money and they can invest in these companies. So generally they demand loan holdings given time for distressed companies. So when a company is going to a crisis, they will come and put their money and they will say, okay, we will put our money, but you have to turn around the company and be ready for a IPO. IPO means initial public offering. That means you go for a public listing. So during the period, they will try to improve the financials, they will try to improve the prospects of the company, and that can happen. Sometimes we have something called leverage buyout. So that's another name, what we call LBO, leverage buyout. There, what happens is that either the venture capitalist or the private equity partner, they will not invest everything in equity. Will take little of equity or some part in equity and some part in debt. The company wants 400 million, they might give equity 300 million and give 100 million debt. Reason, if something happens to the company, equity they might lose it, but debt they will not lose. Because debt, the company is under obligation to pay the interest. Company is under obligation to repay the debt, 100 million. So the equity they might lose it, but they will get. So because of that, the company, the investor will go for what they call a leverage buyout. You put two types of finance, debt and equity together. So when the companies wants to issue shares, there are a couple of parties because imagine your company, the company is expert in whatever they do. I was working for a company, we were experts in selling the housing, the construction material, roofing sheets and all sorts of whatever that is needed for the construction industry, we know. But when we want to come out with a public share issue, we don't have that experience and the knowledge. So we have to get the advice of the advisors. So whenever a company thinks of going for listing, there are certain people, certain parties who can become your advisors. Number one is what they call the investment bank. So this is what we call merchant banks. They will take a lead role in IPO. IPO means initial public offering. First time when you are coming to the market to raise money, that is what we call a IPO. So you don't come to the market directly, you come through an investment bank. You are the company A, you don't come straight to the market, you appoint an investment banker, and through the investment bank only you will come to the market because the investment bank is an expert. He knows how to handle whatever the situation. So you pay some amount and retain the services of an investment banker who will be your main advisor. And they will advise on various things. What are the stock exchange requirements? I remember when I went for the public listing, they told me, Kumar, these are the requirements of the stock exchange. Can you comply with everything? You might need lawyers because the company law need to be interpreted in a different way. So you might need some expert lawyers. They will tell us, okay, you go to these people, they know. The the type of capital to be made available to the public. Should we go for shares? Should we go for debentures? Should we go for bonds? Should we go for preference shares? The investment advisor will advise us. How many shares to be issued and the issue price? Issue price is finally the director's decision. But you can ask the advisor, can we make it 7? Or should we make it 650? Or should we make it 750? Then arrangements for underwriting. Because there is always a risk when you come out with a 2 million share, not all the people will buy. So you want to think of an underwriting arrangement. And also publishing the offer. You have to make the offer published, make it public through the advertisements in TV, through the advertisement in papers, all that. You inform the public, here the shares are available. This is our company, buy shares. So they generally do something through some document called prospectus. Then another set of people who can advise is the stockbrokers. Who are stockbrokers? Stockbrokers, now if you want to buy shares in a company, if I want to sell shares in a company, we have to go to stockbrokers. Each one of us will have our own stockbroker. They are the people who will deal on our behalf. We can't go to the London Stock Exchange and buy shares of a company. I have to tell my stockbroker, I want to buy 10,000 shares of this particular company. He is the man who will go and buy shares on your behalf. You have to pay him a commission, but he is the man. But by virtue of the fact that he is 24/7, he is in the stock exchange, or rather the working hours of the stock exchange, he is there. He knows exactly how the market is. Certain times the market is very good. Certain times the market is very bad. Certain situations when the country is not doing very well, the stock market, the shares will come down. And some people get heart attacks because, overnight their wealth can come down by big amounts. So the stockbrokers know the temperature of the market. They know what shares are going up, what shares are coming down. So this morning I asked my stockbroker, what are the good shares to buy? He said, today everything is good because the price is coming down. Good time to buy. So they can advise. So for a company, they can advise, don't come to the market at this time. Don't come in October. Wait till February. Don't issue it at 7. 7 is too much for your shares. Make it 675. So they can do that kind of a thing. And also, when you come to the market, there are 3 ways which you can raise money. One is what we call an initial public offer or a public offer, where we go and throw the net to anyone and everyone. We advertise in papers, we advertise on TV, everyone can buy our company shares. Then sometimes what we do is we call something called placing. Placing. The stockbroker knows Kumar is a big rich investor. He's interested in buying shares of such and such company or such and such industry. So the moment Boja is coming out with a public issue, your company, the stockbroker knows Kumar is interested. So he will speak to Kumar and arrange a kind of a negotiated price. So it's not something where we come to the market with a predetermined price, but we select some big investors and we offer them the opportunity to buy our shares, and that's what we call placing.
But this happened before
Before a public issue.
A publication, okay.
Before the public issue, because this is a good strategic thing to do. Now imagine you are thinking of coming for a public issue next year June, right? Next year June. So you realize Kumar is a very, very superman, rich man, reputed man. So you offer Kumar before you go public in December 2016, you offer shares to Kumar. And similarly, you offer shares to some other people, the big people in the market. And when you come up in 2017 June, you can say, these people are shareholders of my company. Kumar is a shareholder. So other shareholders will get the message. If Kumar is a shareholder, that means the shares must be good in the company. So it's a strategic way to increase your share price by coming for a placing and issuing shares before the public issue and getting some good names on the board, good names on the shareholder list. That way you can do better. And this is generally the placing. Mostly it is the institutional investors. They are the people who have big money, like insurance funds, pension funds, the banks. The stockbroker knows. Stockbroker will make the introduction, make the link connected, and they will recommend, and those people will invest. The institutional investors, they are also like the pension funds, the banks, they also know very much about the market. They are very active in the market. They buy shares, they sell shares. At one time, I was doing very well in the Sri Lanka Stock Exchange. I was not an institutional investor. I was just an individual investor. But I knew the market so well. And a lot of my colleagues used to come and ask me early morning, Kumar, what are the shares to buy? Later on, I lost the direction. I was not interested so much because with my so much of other work. But when I was doing it, I did it very well, and I knew what shares will go up in price, what shares will come down. So like that, most of the institutional investors, they have done a lot of study on the market. They know exactly which is going up, which is coming down. So you can get lot of advice from those people whenever you want to come out with a share issue.
Okay.
Right. The next topic is a big one. We are going to look at the rights issue. So I will not start it now. If I start it now, I can't finish it. So I'm going to look at that one in our next session. We will look at the rights issue. So
Okay.
rights issue is simply issue which shares to your existing shareholders. You don't go to the entire public market. You issue shares to the existing shareholders. You want to raise money second time, third time, fourth time. You can't go. You can only have one initial public offering. After that, whenever the company wants the money, company will have to go for a rights issue. So the rights issue, there are few things which we need to discuss, but obviously, when it's a rights issue, will come out at a price below the market price to the shareholders, because that's the attraction. Because if the shares are going at 10, and if you come and tell Kumar, I'm going to offer you shares at 10, that's a big idea. But if you say, Kumar, I'm going to offer you shares at 8, that will attract me, because when the market is 10, if you are going to offer me at 8, that will attract me. So that is what we will be discussing, and we should be hopefully finishing that area very soon.
Okay.
When is our next lesson? We did it on Tuesdays and Thursdays we are doing, no?
Sorry?
But today is Thursday. Last time we did Tuesday. Yeah. What is your next available period?
Yeah. Can we change and
Okay.
put Monday and Thursday?
Okay, just a minute. Let's see, Monday is all right for me. Monday is 24. Yeah, next week, Monday and Thursday is all right for me.
Okay, perfect.
Yeah, so we will meet at Monday 7 o'clock and Thursday 7 o'clock.
Yes.
Okay. I sent you the recording. Did you get it?
Yes,
Okay.
I did.
Okay, good. Right, okay. So I will, this was, I will record it and send it to you, and let's meet on Monday 7 o'clock.
Okay, are you going to send me the material, BP material?
Yes, I will send it now. Yes, yes.
Okay,
I'll send it now.
perfect.
Yeah. Okay. Have a great day.
You too.
Bye. Bye.